Hello students, this is a video lecture on the basics of marine insurance where I'll be covering the meaning, scope of marine insurance along with the types and principles. Marine insurance is the oldest of all insurances. I don't know how many of you are aware of this. It dates back to those days when people started transporting goods by sea. Though it was not like the present day insurance policies, ship owners those days had a way to indemnify their loss just in case of any disaster. For example, there was a system called bottomry. As per this, a ship owner would borrow a considerable amount from a creditor to meet the expenses of the voyage before he set sail. He would then return this amount along with a huge percentage of interest upon reaching the destination safely. If unfortunately any disaster strikes the vessel, he would not return the amount. This amount indemnifies him against his loss. Here, the creditor acts like an insurance company. Hi- His business is lending money to ship owners to undertake their voyage. The probability of happening of the risk is very less, just as in the case of any other insurance. 90% he would get back his amount along with a huge percent of interest, and this is his profit. But when any ship is destroyed, then he would have to forgo his principal as well as his interest amount. This arrangement was like an insurance for the ship owners in those days, and this was called as bottomry because they borrowed the amount upon the keel of the vessel, that is the bottom part of the vessel. There was also another arrangement called the respondentia. It was a loan borrowed upon the goods or cargo. The money is to be repaid along with substantial percentage of interest to the lender upon the safe arrival of cargo at the destination. In today's context, even though there is no legal obligation upon the shipowner or the cargo interests to effect a marine insurance policy, the exposure to risk and the magnitude of loss is so huge that no one can afford to operate without an appropriate insurance cover. Moreover, many shipowners mortgage their ships with banks to raise finance, and the bankers insist that adequate insurance cover must be there for the ship against which the loan is granted. Therefore, marine insurance today has become even more significant in international trade than in those days. So let us see what is this marine insurance. It is nothing but a contract between the insured and the insurer to indemnify the loss. Section 3 of Marine Insurance Act 1963, India defines marine insurance as an agreement whereby the insurer undertakes to indemnify the assured in the manner and to the extent thereby agreed against marine losses that are incidental to marine adventure. So it clearly says that there is an agreement to indemnify the loss arising out of marine adventure. So, first of all, we must understand what is the meaning of marine adventure. And section 2D defines it as follows. Number one, it is an adventure where the insurable is exposed to maritime perils. Here, insurable means the subject matter, which can be either the vessel or cargo. And the next one is it is an adventure where the earnings or acquisition of freight is endangered by the exposure of the insurable property to maritime perils. And thirdly, any liability to a third party may be incurred by the owner or by other person who is responsible for the insurable property because of exposure to maritime perils. It must be noted that the term maritime perils here refers only to accidents and casualties of sea and not ordinary activities of winds and waves. So, from this definition, we can understand or we can presume that every voyage is a maritime adventure which requires insurance cover. In India, the marine insurance is governed by the Marine Insurance Act of 1963, which is based on the Marine Insurance UK Act of 1906. And in India, various banks and financial institutions, both private and government, offer marine insurance policies. The General Insurance Corporation of India and its four subsidiaries, the National Insurance Company, the New India Assurance, Oriental Insurance, and United India Insurance are the topmost companies. Besides, there are also many private companies such as AIG, Tata AIG, Bharti AXA, ICICI Lombard, Royal Sundaram, Chola Insurance, and so on. They are all into this marine insurance. Marine insurance is generally taken to cover the damage or lost goods that are transported or the vessel that is involved in transportation. So, based on this, marine insurance coverage comes in many variants. The four main types of marine insurance policies are: number one, the cargo insurance. This is not only for the cargo during sea transit, but it also covers land and also air transportation. It also covers any loss or damage to the cargo during loading and unloading also. And number two, hull insurance, which is for the vessel. The third one is freight insurance. So this is taken to cover the loss of freight to vessel operator. You must understand a vessel operator is supposed to receive the freight amount upon safe delivery of cargo at their destination. But sometimes, if cargo is damaged or lost, he will not be able to get the amount. This loss of freight can be covered through freight insurance. And the fourth type of marine insurance is the liability insurance. This is actually a part of hull insurance. When the insured vessel collides with another vessel and causes damage to the other vessel, the damage or loss caused to the other vessel owner can be covered through this liability insurance. In this case, the claim from the other vessel owner is termed as third party liability. Thus, the scope of marine insurance extends beyond sea voyage. It covers third party liability, and also it is extended to cover land and air transportation also. It also covers the loss of revenue to the vessel operator through freight insurance. So you must understand the wide coverage of this marine insurance. So let us move on to the basic principles of marine insurance. There are five basic principles that govern marine insurance. We shall see one by one. The first one is called as the principle of utmost good faith. The marine insurance policy relies on the principle of utmost good faith, which clearly states that at the time of filling the marine insurance policy document, the applicant should disclose the correct information. Also, the applicant should not withhold any material information. Suppose if the applicant conceals or hides important information, then the marine insurance company has all the rights to reject the policy application. So I'll give you an example for this. Suppose let us assume there is a shipping company, Great Eastern Shipping Company, and it is planning to buy a marine insurance policy. So this means the company should disclose all the material information about its current state. In case the company hides any material information, the marine insurance company has all rights to reject the policy application. Even if at the time of the claim the insurer finds out that the company has hidden some material facts, it can reject its policy application form. So this is the concept of utmost good faith. And the second principle is the principle of insurable interest. According to this principle, it is necessary for the policyholder to have some insurable interest in the subject for which he or she wants to buy the insurance. It means the policyholder should be benefited from the safe arrival of goods or should suffer loss due to damage of goods. It might happen that the policyholder does not have an insurable interest at the time of buying a marine insurance policy. However, he should expect getting such interest in the future. It is necessary that the policyholder must have some insurable interest in the insured item. Otherwise, he will not be able to get the claim settled from the insurer. I'll give you another example for this also. Let us assume there is a company, KM Manufacturing. Uh, they buy a marine insurance policy for the consignment, which it was which was to send to Sri Lanka. Now, once the consignment reached the destination, the insurer's liability also ended at that point. As KM Manufacturing had an insurable interest in consignment, it bought marine insurance, but as soon as the goods reached the destination, its insurable interest was over, and therefore the marine insurance company was not liable to pay for any loss or damage which happened to the goods after delivery. The third principle is the principle of indemnity. As per this principle, the marine insurance policy holder would be compensated only to the extent of the loss. It means the person should not purchase marine insurance to earn profits. In any case, the policy holder will not get more than the actual loss incurred. Again, I'll give you another example for this. Let us take there's a company that is MK Tech. It has a vast base of clients which spread around the world. The company has purchased marine insurance to get coverage in case something goes wrong. The total cover available under the policy is rupees 50 lakh. It means MK Tech will not get more than the loss even if the sum insured is more than the loss. It means if the loss is rupees 20 lakhs, MK Tech will not get more than the actual loss, that is rupees 20 lakhs, even when the total cover is rupees 50 lakhs. So this is the principle of indemnity. The fourth principle is the principle of cause proxima. At the time of loss, the marine insurance policy holder would consider the nearest or the proximate cause, which would help in deciding the actual cause of loss when there would be a series of causes which have attributed to the loss. Here, the remote cause for a loss is not required to determine the liability, and therefore, if proximate cause is insured, marine insurance company has to settle the claim. So I'll give you an example for this also. Suppose, let's assume rats puncture a cargo ship, and because of that, water enter and damage the cargo. Now here there are two main causes for the cargo damage. One is the cargo ship got punctured due to rats. The other one is the seawater entered the ship through holes. In this case, the owner had a marine insurance policy, and the nearest cause of the damage was water, which was covered by the policy, and therefore the insurer settled the claim accordingly. So, in this way, when there are many reasons to the damage or to loss, they try to establish the major reason, main cause, which is called as the proximate cause. And if that is covered through the policy, then the insurance claim is settled. Then the fifth principle is the principle of loss minimization. So just because someone has a marine insurance policy, it doesn't mean the person can act carelessly. It is necessary for the policyholder to take all the steps to curtail and minimize the loss. The policyholder must not behave irresponsibly during an accident just because the property is insured under marine insurance. And this is the concept. I'll give you an example for that also. LF Electronics got a major contract of exporting electrical items to a buyer situated in Dubai. To get protection against various losses or damages, the company also purchased a marine insurance policy. In this case, the company had a marine insurance policy, but it did not mean that LF Electronics could act carelessly. It means LF Electronics would require taking all precautionary steps to curtail the loss or damage. In any way, LF Electronics couldn't act carelessly just because it has purchased a marine insurance policy. So these are the fundamental principles upon which the marine insurance operates. So I hope this would have given you an idea on what is marine insurance, what are the types of marine insurance, and what is the scope of marine insurance, and also the principles based on which the marine insurance is done. Thank you.